Hey there, this is David Cox, Senior Portfolio Manager at Financially in Sync at Raymond James in Waterloo, Ontario, Canada. Today on the webinar, Where Do We Investors Stand? It is Friday, December the 19th, 2025. Let's get started. We will, as usual, start off with the weekly intermarket stuff, everything from gold on the top down to small caps US on the bottom, and everything in between. You can see stocks over here a bit of a week off, but at the same time, we've got lots of trends, lots of things. I got a couple data here, just a reminder, pause your video player at any time to get more details. Let's look at the S&P 500 on the left. That's U.S. stocks. We got the Canadian stocks on the right. I think it is more and more important to talk about Canada. And I want to mention it today. So first off, there's the bottom panel. We've got a simple RSI 5 on the daily. Those are what I call pullbacks. And if we're in uptrends, buying pullbacks and uptrends or adding risk is generally something that I like to do. You can see on the left side here, we did not make a higher high. Whereas the Toronto market in the green circle on the right here went to highs. So the Toronto market has been outperforming all year long, and that has been something that has dramatically actually changed the past history. And that's what happens, right? So time builds, it starts somewhere. And what I want to show you is exactly this. So again, I'm going to suggest you pause your video player here, but if you take a look at the top panel, what we've got is gold, we've got US stocks and Canadian stocks. Here's the 1 year time frame. So you can see Toronto has almost doubled the return of the US market in the past year, but over the course of the last 10 years, without question, first off, gold has outperformed on a 1, 5, and 10-year basis, both markets, but the Toronto market, you can see here, has been quite a laggard over the longer term. Now, a year ago, here's the exact same panel, what the data would have looked like, and here we had different remarks. We had the US market was definitely the strongest. It had outperformed gold actually significantly, and it had very significantly outperformed the Toronto market. So you can see the difference that, honestly a year makes, because in the 5-year column, if you look here closely, you can see here today, I mean, you've almost got similar 5-year returns, but a year ago, the 5-year returns were like, I mean, you had almost 50% of the return only available from Toronto stocks. So again, the Toronto market is very different. Sectorally, the composition is very different, a lot more financials, and certainly the materials and energy stocks are well represented. So let's look at the biggest stocks on both sides of the border. Here's the biggest stocks in the US. This is the performance over the course of the last month. Tesla has been the top performing stock in the market, up 20%, and you can see there's the S&P 500. So you've only got 4 stocks out of the top 10 have outperformed in the past month. Nvidia actually is on the bottom, and there's Broadcom and so forth. Let's flip over to the Canadian side, and on the Canadian side, you'll see definitely a theme, and you'll see if you highlight the S&P TSX Composite, you'll see it's mostly banks. So the banks have done very well, and there's Shopify up at the top. This again is just 1 month performance of the top 10 stocks by market capitalization in both sides of the border. Now let's do the comparison of the big versus the big. On the left side, we've got Nvidia. This is about a 5-year chart, almost I guess 6 years. And so Nvidia on the left, obviously an uptrend. I'm pointing out the green circle here because right now we've got a pullback to that 34-week green moving average. Looks like a pullback. That's all it is. There's nothing more to say. Royal Bank, on the other hand, there is not in a pullback. It has been actually surging. You can see definitely in an uptrend. But when we compare the two of them, so this is now Nvidia divided by Royal Bank, you can see this is a 5 or 6 year uptrend. Now, again, what does that mean? This is hard to understand sometimes because we've got an absolute chart. We're saying that both of the stocks are going from the lower left to the upper right, but then when we plot one versus the other, again, we've got lower left to upper right, which means Nvidia has been actually massively outperforming Royal Bank. And here we've got actually a pullback underway. Let's look at a couple of stocks here from the All-in-Sig pool. A couple of the defensive names, Dollarama on the left, has been just a real strong stock over a long time period versus the Toronto market. It really is a bellwether stock and has actually very low ATR, so very low volatility, as does Loblaws, one of the largest grocery companies in Canada. And then on the right side, we've got Cameco, much more volatile stock, but either way, we can see the general idea here over the course of the last couple of years. We've got lower left, upper right, and on the bottom panel, I've plotted these versus the Toronto stock market, which means that they are outperforming the stock market over those time periods. Let's look at a couple of the industry focus here. So the US market does not have much materials representation. It does have some. The Canadian market, much more healthy. I think it's about 17% actually. So these are 4 industry groups. So this is not the materials broader sector, but 4 industry groups I think are, happening and important right now. You could kind of see the differences here. So everything in the top right, from lithium to gold mining, copper, and rare earth. I guess the only point I can make easily is the rare earth metals, again, been very strong, but if you see, they're not making highs right here over the course of what's been going on the last couple of months, and that's fine. Stocks are allowed to consolidate, but I think it is very important, given what's going on in terms of that relative performance versus the US market in the last 4, 5, 6 months, that we want to continue to pay attention to this sector here as we go forward into 2026. Let's just finish off here with kind of what we call an vertigo style stock. So this is a growth stock that breaks out of a base. This is a stock actually that broke out, prior, back on the left side of the chart here. This is actually another breakout, but really I want to focus on the one in the middle part of the chart. Last spring, I guess, it broke out. This is out of a, we'll call it a 6 month at least. Actually, it's almost a 1 year base. And this is when a stock basically experiences overwhelming demand relative to supply. Investors decide that a whole new price level is, possible and required. And that's exactly what happens. So I like to buy those kind of points, which is that breakout point. And you can see here where we trimmed a third of the stock. It had run very far. And of course, when a stock adds tremendous value to your portfolio, what you need to do is be aware that position sizing grows naturally. Anyway, needless to say, yesterday the stock was down. I think it closed down 16 or 17%. This is a gap down. This is a gap down, obviously, against prior trend. Certainly not what I would call the biggest bar, but it still is the obvious bar. And so again, we push sell and we take our profits. It is part of investing. Investing requires not only risk management, but return management. And again, the opportunity to sort of decide that the trend has changed is important. It's never about buying the low. It's never about selling the high. It's about sort of going and participating in what is available to you as an investor on your time frame as appropriate. Let's finish off with sector watch here. There's the top. We got the REITs up at the top on the Canadian side. There's the defensive consumer staples. Again, I'll just point out the REITs though, short, intermediate, long-term down. And again, there's the real estate sector in the US. Real estate has just been an awful place to be, no doubt about it. It's been that way for several years. And again, there's no surprise. That's because interest rates, of course, have been high and rising and at least stubbornly turning sideways. Needless to say, this will be the last webinar for the year. I think we'll have a little quieter time here at the office over the course of the next couple of weeks. But I wish each and every one of you a very Merry Christmas and a happy holidays. And again, I will see you in the new year. This has been David Cox, Portfolio Manager at Financially in Sync in Waterloo, Canada.